Welcome to this video on the untold story of America's banking crisis. In this video, we'll take a deep dive into the financial crisis that rocked the United States in 2008, causing widespread unemployment, foreclosures, and economic recession. We'll examine the root causes of the crisis, the key players involved, and the impact it had on ordinary Americans. The 2008 financial crisis was a result of years of deregulation and risky lending practices by banks and financial institutions. The housing market had boomed in the early 2000s, with low interest rates and lax lending standards allowing people to buy homes they couldn't afford. Banks were eager to issue loans, knowing that they could package and sell them as securities to investors. This created a housing bubble that eventually burst, causing home prices to plummet and borrowers to default on their loans. At the same time, financial institutions were engaging in highly speculative investments, such as mortgage-backed securities, that were highly leveraged and exposed them to significant risk. When the housing bubble burst, the value of these investments plummeted, causing many banks to suffer massive losses and leading to a credit crunch that froze lending in the economy. The key players in the crisis included large banks like Lehman Brothers, Bear Stearns, and Merrill Lynch, which had heavily invested in the housing market and were highly exposed to the risks of the housing market collapse. Other players included mortgage lenders and credit rating agencies, which had inflated the ratings of risky securities and misled investors. The impact of the crisis on ordinary Americans was devastating. Unemployment soared, with many people losing their jobs due to the economic recession that followed. Foreclosures on homes skyrocketed, with many homeowners unable to make their mortgage payments. The government was forced to intervene with massive bailouts of the banking industry, which angered many taxpayers who felt that they were footing the bill for the mistakes of Wall Street. In conclusion, the 2008 financial crisis was a result of years of deregulation and risky lending practices by banks and financial institutions. It had a devastating impact on the American economy and on the lives of ordinary Americans. While some reforms were made in the aftermath of the crisis to prevent a similar meltdown from happening again, there is still much work to be done to ensure that the financial industry operates in a responsible and sustainable manner.